income statement, balance sheet, and statement of cash flows are three heavily used financial statements of public companies. The income statement shows income on an accrual accounting basis. Revenue is recorded as it is earned rather than when cash is collected. This allows the pairing with expenses as they are incurred. One result of accrual accounting is that many assets, such as capital expenditures, have their cost depreciated over time. The lower part of the income statement shows earnings per share for the period. Investors are interested in this value because it shows how much income has been generated for each share that investors hold. Earnings per share diluted is a more conservative value than the basic EPS because it assumes that more shares are outstanding. The financial statements displayed here are standardized for comparability across companies and industries. They do not exactly match the account names used in the statements as prepared by the companies and filed with the SEC. Many useful ratios and growth measures can be calculated from the components of the income statement, such as gross profit margin and EPS growth. Combining the income statement items with market data is useful for valuation such as price to earnings per share, otherwise known as PE. The income statement is an array of raw data that can be analyzed in many ways. Some of the more basic ways might be to view the trend in the account back in time. For example, Johnson & Johnson's total revenue has grown in most of the history shown. The latest value of $71 billion is much higher than the 2004 value of $47 billion. Another way to view income statements is by column. For example, in 2013, the $71 billion in total revenue translates into $13.8 billion in net income after deducting the various expenses.